think it'll be helpful if we step back and look at the bigger picture for EM and TM, rather than getting lost in the month to month. As you were describing, the month to month is extremely uncertain. What is relatively clear is, since the end of QE around a year ago, the US 10-year bond yield by and large is heading up. It was 1.6% a couple of years ago, which I think is closer to 3.1% now. And to the extent the Fed is not going to bring QE back, I think the cost of capital globally. Remember, the American 10-year bond yield is the world's risk-free rate. The world's risk-free rate bottomed out around 18 months ago. And as the American 10-year bond yield heads up, the American economy normalizes. Whether the Fed hikes or doesn't hike, we are in a world where super cheap money that characterized the last 10 years is gone. If you take super cheap money out of the picture, then risk assets, whether they be cryptocurrencies, whether they be oil, emerging market equities, developed market equities, I think risk assets have a far tougher climb over the next 10 years than they did over the last 10 years. In a world with free money, risk assets, and cryptocurrency was the classic exemplification of it, went to levels which were just beyond any rational explanation. In a world where money means something, cost of money, cost of capital rises, I think we're in a far more measured risk climate. Now that doesn't mean necessarily bad news for our country, especially since the oil dynamic, as Adrian explained quite nicely, the oil dynamics is favorable for us. But I think what it does mean is we go back to sort of classical investing precepts. Buy great companies, sit tight, make money from them. It's worked well in India over the last 10-15 years. I think people like Bharat Bhai's career in a way is a demonstration of how classically high quality investing makes you tons of money in this country. There's almost no need to go out and speculate. If you buy great compounders, you make tons of money. I think that mode of investing will serve us well, even over the next 2-3 years. If someone had to be more opportunistic and say, hey, I'm not just satisfied buying companies that give me 10x in 10 years and 100x in 20 years, I want to shoot the lights out. If you want to be more adventurous, then I think 2 or 3 things worth looking at is, I think well-funded banks clearly will do well. I think the NBFC boom really is past us. Most of the NBFCs are well run, they will pull through, but clearly there are, I would say, a good third of NBFCs who are in serious trouble, and I think will stay in trouble over the next couple of years. So well-funded banks, I think, will be a good thing to focus on. I think our pharma sector has been pounded beyond belief. I think there's a long overdue recovery that I think Indian pharma will go through. And the third theme, I think Vikas mentioned it, and I think will come back again and again, is I think Indian manufacturing, long in the shadows, Indian manufacturing will have a recovery as the RBI data is clearly showing. The capacity utilization in the economy is hitting 75-80%. So our manufacturing sector, our capital goods sector, has a long overdue recovery ahead of us. But leaving the opportunistic themes aside, classically high quality investing has worked before, I think will work, especially as globally the cost of capital normalizes after an exceptional 10 years of super cheap.